Welcome, guys, and welcome to this new session. This new lesson, we are going to talk about risk management. And as we all know, risk management is a very important part of trading. There is no way you are ever going to trade successfully without applying proper risk management. And for those who are planning to take this very seriously, for those who are planning to trade, probably for a part-time or a full-time business, you need to understand and implement risk management the right way. And for this reason, I'm going to be going over risk management one more time, just to better emphasize how crucial and how important, and also the effective ways you can use to implement these things to your trading to better your results also. So we are going to go into what we have for the session, and this session is going to be in 3 parts, not to make everything so packed up. So we are going to divide this into 3 different lessons. So this is the first one, and we have 2 other ones to follow after this one. So a quick introduction to risk management. Risk management is a way and techniques you implement to minimize your potential losses and also maximize your potential profits. In trading, there's always going to be a possibility for risk and also for profit. So this is an explanation I put together on risk management. So risk management in forex trading refers to the strategies and techniques that traders use to minimize potential losses, right? This is the key word here: minimize potential losses while maximizing potential gains or profits. And like I said, in trading, there is always a possibility for risk, and that's what we have. It carries inherent risks due to the market fluctuations and volatility. So there's always a potential for risk in every trade. There's no such thing as a guaranteed winning trade. There is no such thing as a guaranteed winning trade. So there's always a possibility for losses, right? So this is why it is very important we prepare adequately for any possibility for loss that may happen while trading. So if you fail to prepare for losses, then it's just a matter of time before you lose your trading account. So proper planning is very important to better prepare and manage any possible losses that may occur during trading. So effective risk management is crucial to preserving capital and ensuring long-term success of a trading system. So the trading system is not all that you need to know to trade. Risk management is very, very important, right? I cannot stress it enough. You need to apply risk management the right way if you want to do this for a long time, or you want to do this and avoid losing account or building an account and then having losses, which is very bad the next day, right? So we do not want to have a roller coaster kind of growth. We want to have a smooth growth whereby we can see consistent wins over a long period of time. That's the kind of growth we would like to have in trading. So traders should have a comprehensive plan in place to manage risks effectively and make informed trading decisions. This is another keyword you need to pay attention to make informed trading decisions. So in trading, there should be nothing like surprises, right? There is nothing that happens in the market that should be a surprise to you, right? So this is why when you make proper planning, you make plans for whatever outcomes that may happen, right? So it is very important we make comprehensive plan in place to make informed trading decisions. So we are going to go into what I've planned out for this very first session. And the first thing we are going to look at for now, I have something over here we are going to pay attention to. We have the first point here, which talks about the stop loss and target levels and the risk reward ratio. So this is the first point I would like to address on this first one, and then I'm going to continue with the other ones also. So the first one I'm going to talk about here is risk to reward. Okay, is stop loss and target. So what are stop losses and targets? How do we set these things? So this session also is going to be very practical. So we'll be doing a lot of examples on the chart so you can see exactly what goes into these things. So what are stop loss and targets? Let's go on the chart and see how to set proper stop losses in trading. So anytime you're in the market, you are trading, you should not trade without stop loss. Stop loss and target. These are two things you should have planned out before you get into a trade. Before you click on buy or you click on sell, before you click on any of these two, you should have your stop loss level, your target level in mind. That is very important. Very important. And how do we set stop loss? And how do we set TPs, target levels? This is very easy to know when you understand how we approach the market, the blue vision system of trading. When you understand your moves, when you understand your trend, your levels, it makes it very easy to know how to set your stop losses and your target level. So I'm going to look for an example of how to set a good stop loss in the market. So the first thing I would like to say is that for as long as you are doing a day trading, your stop loss at any point in time should not go beyond 40 pips. I recommend nothing more than 40 pips, maximum of 40 pips. So you may have stop loss between, let's say 25 to 40 pips, maximum of 40 pips on every single trade that you take. So stop loss should not go beyond 40 pips. When you have a trade which requires more than 40 pips stop loss, there are things you can do to be able to accommodate to take such trades. So I'm going to come back to that some other time, but let's go into how to properly set your stop losses. So before you take any trade, the first thing you always want to do is have a good trend. You need to understand what is going on that trend. So let's say, for example, we have a trend like this in this case. So here we have a downtrend over here, and the first thing you would see here is price did this correction, and this correction is testing a good level for sales. So when you understand the BV system, you would know this is a good place for a continuation trade. This is a TCT on this downtrend. And when you look at what we have right there, we have good confirmation candlesticks, good reversal candlestick right inside of our entry level, right? So once you are able to identify these things, so the first thing you want to do in this case is you need to mark out your entry level. You need to mark out a zone. So this zone here stands for my entry level, which means I'm looking to take entry anywhere inside of this zone. That is my entry level. So the first key point you need to note when setting your stop loss is you need to look for an entry confirmation. You need to find an entry confirmation. And for as long as taking entries is concerned, I'm really not going to advise using pendings or limits. Limit entries or pending entries are not really good because you are not able to set a precise stop loss. So it is always good to have a good confirmation printed, and the confirmation you are able to spot before you take your entry. So in this case, we are looking for entry confirmation inside of this zone. So this is my H4 time frame. So when price is inside of this zone on my H4, I'm simply going to mark out these things, right? This is exactly how I approach the market, right? So I see something like this going on. I can see this downtrend, okay? And price has come all the way inside of this good level for short. So what I'm looking for inside here is some rejection candlesticks, reversal pattern or market pattern. So most importantly, candlestick reversal patterns inside of this zone. So this is my 4-hour time frame, which means there is a chance for me to go down to my smaller time frames, my M15, my M30, my H1, to look for reversal candlesticks inside of here. So let's quickly go down to a smaller time frames to see what kind of candlestick pattern we would find inside of this. On the H4, you would find this very clean pin bar, right? This is a rejection candlesticks, very good pin bar on the H4. But on the smaller time frames, you would find something even more than this. You should see something better than this on the smaller time frame. So let's go on the H1 and see what we have here. So on the H1 here, you can see we have a lot of rejection candlesticks, which looks very clean also. So when I see something like this, the first point is that I already knew I was looking to short this market. So the only thing I'm interested in on this time frame is entry confirmation, which means I simply want to see what happens inside here, inside of this box. So I'm looking for reversal candlesticks pattern. So the first thing you will see here is a reversal candle pattern. That is a pin bar right there. That is a pin bar right there. We call that a shooting star. So we have a good rejection candlesticks. All of this here also are rejection candle patterns. So once you spot something like this, you can use that to pick your entries. But before you pick your entries, you need to pick your crosshair to calculate, to count the pips, to calculate the pips. So if you're able to find after this candle close up, after this candlesticks rejection closes, you are looking for about 40 pips or 30 pips, right? So you may go with 30 pips in this case, which is also a good one. You may go with about 30 pips or 40 pips maximum. So anywhere you pick your entry over here, anywhere from whichever place you pick your entry, looking at these reversal candlesticks, your reversal candlesticks should be your focus now. So my focus right now would be on these reversal candlesticks, which means my entry should be anywhere around these candlesticks, anywhere inside of this range of these candlesticks. That is where I want my entries to be. So whichever place you pick your entries, you need to set about 40 pips or 30 pips above. So this here is my 40 pips maximum. You have 30 pips right here. So you set your stop loss to the high. So the first way to set a stop loss in this case is by looking at, by calculating your pips from this candle close and count about 40 pips, right? You can do something like this and count about 40 pips. This here would be your stop loss. 0.91439, that would be your stop loss in this case. And the second way you can do this is by looking at from this high, from the high of this reversal candlesticks confirmation you have, you simply look for about 20 pips or 15 pips. 15 to 20 pips from that point, that would be your stop loss. Right from the high of your rejection candlesticks, these are the two ways you can set your stop loss, right? From the high of your reversal candlestick, you simply count about 20 pips, about 20 pips to the high. That would be your stop loss. That would be a stop loss because a good stop loss must go above the entry confirmation. A good stop loss must go above the entry confirmation. So here you have your entry confirmation, which is this rejection candlesticks. If you go on the smaller time frames, you'll find other rejection patterns inside of this box. But this is what we are using right now for this example, which means your stop loss should be above this high. So you simply count 20 pips from this level, or you simply count 40 pips right from this low and count 40 pips, or whichever price you have in this box, right? If your price is right at this spot here, you can count about 40 pips or 30 pips. That would be a good stop loss. So this is the easy way to set stop losses. And this is why I told you using pendings or limits are not advised, are not recommended. So it is best to wait for a good reversal candlestick pattern to be printed inside of your entry level. So by this time, I believe everyone should know how to find your entry level. If you have your trend, you should know what kind of setup price is giving you. When you have a trend, you have a downtrend, you know where to look for TCT, you know where to look for CTT. So if you are looking for a CTT, which means you are looking for a possible longs from this low here. So all you want to see here is reversal candlestick pattern inside of that low, and then you can have buys in that case. And then you may have buys in that case. So this is simply how to set your stop loss. These are the two easy ways to set your stop loss. What you need is your reversal candlestick pattern inside of your entry level. So always wait for reversal candlestick pattern inside of your entry levels. And when you have, in cases whereby you are not able to find about 40 pips or 50 or 30 pips, you are not able to find about 40 pips stop loss, you may reduce your lot size into half and use 40 pips, right? And use about 50 pips in that case. So let's say, for example, from here all the way here, you have about 50 pips, or the market is very volatile, you got about 60 pips stop loss, and you really want to take that trade. The simple technique to use in that case is to divide your lot size by 2. So if you were gonna use one standard, you may use 0.50. And in that case, you are able to get a good stop loss for such trades. So setting stop loss, this is the easy way, very simple way to set your stop loss. Look for entry confirmation inside of the entry level. You need to find an entry level, understand your trend, map out your entry level, and look for entry confirmation inside of that level. This is my trend, which is a downtrend. You need to find a trend. I have a downtrend in this case, and price has pulled back inside of my entry level, right? So I have something like this. So I have an entry level and I have an entry confirmation, which is this rejection pattern there. So once these two conditions are met, your stop loss is very simple to set. So you are looking for 40 pips from this low, or from anywhere within, or you look for 20 pips from this high, 20 or 15 pips from this high. This is the two simple ways to set your stop loss. Stop loss are set based on entry confirmations. So if you do not wait for entry confirmations before taking entries, then you would be having the wrong stop losses. So having the right stop losses is really important to your trading progress. So this is really what you need to know about stop loss. And the next point here, which is take profit, how to set your TPs. So just as we have with the stop losses, setting TPs are actually very easy, because once you know your trend, once you understand your trend, you are able to set your TPs without stress. So in this case, we are looking for short from this high, and definitely you should know your next low is your TP. So the next low in this case is right here. So definitely this would be my first TP. That would be my first TP. So when price gets to that low and price starts rejecting, you should know it's time to close your trade. And this in this case also, we have a downtrend. So if on this downtrend you believe price is gonna break this low and create a new low, you should know you need to protect your entry or close a portion of your trade. So what you need to do in that case, if you believe price is gonna create a new low, you can close about half of your position. So if you have one standard over here, you can close about 0.50 and hold 0.50 all through to this low. So it is very good to secure a portion of your profit before such a break or hold happens right here, right here. So setting take profit is very easy once you understand your trend by using your swings and your pullbacks. Swings and pullbacks makes life very easy. You're able to spot the key levels on that very trend. So that is really what you need to know about setting stop loss and TP. So TP levels are based on the highs and lows of your swings, right? The next high, your next low, those are your target levels on your main time frame, your major time frame. Those are your next TP levels. So that is that about setting stop loss. So I believe from now you know how to set stop loss. Look for entry confirmation inside of your entry level, and then count about 40 pips. Stop losses on a day trading should not exceed 40 pips. Should not exceed 40 pips. So we've talked about stop losses. We have also talked about TPs. The next thing I would like to talk about is the risk to reward. Risk to reward. So this is also one other aspect of trading which is very important. when you look at risk management and trading, the risk to reward comes very important. It is really important because, like I said, for every trades, there is always a potential for risk, right? So if you are trading and you cannot deal with risk, you should not be trading if you have issue dealing with risk, right? So in trading, we have ratios when it comes to risk to reward. Your potential for gain or for reward should outweigh or should be more than your potential for risk. I always advise nothing less than 2 to 1. For this, I advise no less than 2 to 1, right? 2 to 1, no less than that. So which means if your potential for profit is 2, yeah, if your potential for risk is 1, your potential for profit should be 2. So if you have about 40 pips stop loss, your take profit should be about 80 pips, right? Should be about 80 pips, something like that. If your stop loss is about 30 pips, your take profit should be no less than 60 pips, which means you need trades that gives you these 2 to 1. So it is not every single setup that you need to take in the market. Your setups in the markets should go in line with a good stop loss, should give you a good stop loss in terms of pips, and also should give you a good risk to reward. So if a trade setup, technically, it does not mean it's always gonna give you all of this, right? When you have a good trade setup, it should give you a good stop loss, should give you also a good risk to reward. You need to consider these things. So what this risk to reward simply means is, if you are trading and you have about stop loss of about 40 pips, you have stop loss in this case of about 40 pips, let's say 40 pips right there. Your TP in this case should be more than 80 pips. Over here, we have about 100 pips, which means we have a very good risk to reward in this case. If you risk about 40 pips, you stand to gain about 100 pips, which makes this a very good setup or a very good trade because we have good risk to reward. So for every single setup that you plan to take, you need to watch this. You need to watch this. Your stop loss can be something like that. Your TP should be twice or more than that. Twice or more than that. So you may have stop loss like this, and you may have TPs like this. So that is what we mean about risk to reward. And risk to reward is really, this is where the magic of trading happens, because really when you apply good risk to reward, you do not need to win even half of your trades to be a profitable trader. It becomes very easy to realize profits in trading. When you apply risk to reward the right way, you do not need to win even 50% of your trade to be a profitable trader. It gives you enough advantage in the market for profits. So if you have a very poor risk to reward in your trading, you may need to have a very high winning ratio for you to be a profitable trader. But even with a poor winning ratio and good risk to reward on your trades, you stand to be profitable very easy. So with this 2 to 1, all you need to do is you really need to win about 30% of your trades. About 30%. If you are able to win no less than 30% of your trades, you are a profitable trader. So let's say, for example, you took about 10 trades. For example, you took 10 trades. So on 10 trades, you should win no less than 3. On 10 trades, you should win no less than 3. If you win 3 trades on these 10 trades, you have a good potential to realize profits after the whole trading session or trading week or trading month. So it gives you a good advantage to realize profits even faster. So 2 to 1, 3 to 1, this trading, this risk to reward are very important. So any trade you're gonna take in the market, you need to make sure it gives you a good risk to reward, right? So if you have a 1-to-1 risk to reward, it is not a good one in my books, because with that you need a very precise and a high winning rate on your trading to realize profits, which means if you lose 5 trades, you win 5 trades, you are back to zero profit. You are back to zero. That is what that means. On a one-to-one risk to reward. On a one-to-one risk to reward, if you took 10 trades and you lost 5 trades, you won 5 trades, you have zero, right? You have made $0. You are just back to nothing. So which is why 2-to-1 is very important. On the 2-to-1, you lost 5 trades, you won 5 trades, you have made money. You have made money, right? Because let's say, for example, on one single loss, let's say your 40 pips loss is equal to about $100, 800 USD. That is your 40 pips. That is your 40 pips stop loss, right? And your take profit in this case, let's say you have about 200 USD, which is 2-to-1. So 200 USD, which is your 80 pips, right? That's like a TP. So no less than 80 pips on that for a TP. So in this case, for a stop loss. So if you have something like this and you lost 5 trades, if you lost 5 trades, you lost 500 USD. If you won 5 trades in this case, you won 1000 USD, which means at the end of the day, you have 500 USD profit to yourself. So if you lost 5 trades on this 1-to-1, on this 2-to-1, so this in this case is a 2-to-1, right? This is a 2-to-1. So if you lost 5 trades in a row, that is equals to 500 USD. And if you won 5 trades also, you have 1000 USD. So at the end of the day, you are left with about 500 USD profits. So this is one example that you won only half of your trades. You won just half of your trades. So if in an example whereby you lost 6 trades, you won 4 trades, you are still considered a profitable trader. If you lost 6 trades, you lost 600. You lost 600 USD. And if you won 4 trades, you won 800 USD, which means you have 200 USD profit. So your winning trades could be, your losing trades could be higher than your winning trades, and still you're still gonna be a profitable trader. So you do not really need to get a very high winning rate to be a profitable trader. You may have a high losing rate and still be a profitable trader. That is the beauty of risk to reward. So for every single trade that you take in the market, it is very important you apply proper risk to reward to them. So you may take these things to practice, look at how these things play out. Like I said, all you need to do on a 2-to-1, at least 2-to-1 risk to reward. In most cases, you may have 3-to-1. On the major time frame, your day trading, you may have 3-to-1 in a lot of cases, right? So which means you start to make even more profits. So it is time to change our perspective from trying to win every single trade. Losses are a part of the game, but when you're able to manage your risks, apply these systems the right way, even on a high losing rate, you still can be a very profitable trader. And with the system that we have in Blue Vision, it gives you an advantage to win most of your trades. If you're able to master the Blue Vision system and you apply it the right way, you have a very high potential for making winning trades, which means your rate of profitability should be very, very high. But in the worst case whereby you win 500 of your trades, you lose 5 of your trades, you are still a very profitable trader. If you lose 6 of your trades, you won 4 of your trades, you are still a very profitable trader. If you lose 7 of your trades, you won 3, you are still a profitable trader. This is all because of risk management. This is all made possible by applying proper risk management. So risk to reward, these things is very important. You do not take just any setup in the market. You need to be very selective. You need to carefully select all your trades. So you are looking for trades that goes in line with your requirements. You need to see a good, at least 2-to-1. You may have 3-to-1, 4-to-1, sometimes 5-to-1, which is very good. But the minimum criteria you need is a 2-to-1. So when you have a good 2-to-1 risk to reward, you have a good, it is a very good potential trade to look out for. And also, you need to be able to get a good entry which affords you a 40 pips stop loss maximum. These things are very important. So this will be the end of this first session. And the next session, I'm going to go into other aspects of the risk management series. Thank you and tune in.